All right. Today we're looking at which strategy works better in trending dollar markets. Here, we've covered the backdrop of what's going on in forex markets today, but let's cover the background real quick again. It's a mixed dollar story and a very interesting mix at that because rate cuts getting priced out a little bit, but still favoring a September cut has caused some chop in some major US dollar markets like Eurodollar, yen, Swiss franc. But we have seen some trending moves against risk on currencies. This week, we've seen US dollar posting 3 consecutive days against Australian dollar, Canadian dollar, and even the Great British Pound, and the New Zealand dollar as well, with a high correlation to Australian dollar. So we're seeing some risk off sentiment benefiting the US dollar against those pairs, but not against some of those historic safe havens like yen and Swiss franc, as well as volatility in FX remaining on the lower side in August, a slower month than we've seen, especially at the beginning of the year with all of those tariff talks. So I wanted to look into whether contrarian or momentum strategies work best, especially with these trending markets.
Sweet.
So what we did, the study here is we looked at the past 6 years of price data using daily high-low open close for the major US dollar pairs, all 7 of those that we've covered so far, and looked for 3 consecutive up or down days in each of these pairs as trade entry criteria. So not necessarily requiring a pair to trend in the US dollar's direction, whether it's a US dollar slide or appreciation. We use that as entry criteria. And this time used asymmetric risk reward to fit an assumption on the low volatility environment, here using a risk reward ratio of 2-to-1. So that's saying that we're looking at a smaller price target for profit and letting it run a little bit on the stop loss level to account for, we're looking for small profits here. I think I used 0.5% as a profit target and 1% as the stop loss in each of these pairs.
So you're going to get a little boosted win rate.
Exactly.
But it'll be interesting to see how it affects the P&Ls.
And for here, just looking at a 5-day max holding period. So a 1 trading week, if you're looking at these trending markets, which works better over the shorter term horizon, and calculated a ton of metrics. So first, let's look at, I think, momentum. Go to the next slide. Yeah, here we're looking at momentum strategies. So we're seeing right off the bat, US dollar, Japanese yen emerge as the outperformer. But what I've done is highlighted here the pairs that currently fit this criteria. So like I said, we've got pound, Canadian dollar, Australian dollar, New Zealand dollar. If you're hopping in right now to look at these markets, these are pairs that would fit this criteria if we entered in this morning. So we're seeing, even for momentum here, we're seeing positive win rates across the board. But like you said, with our asymmetric risk reward needing a lot higher win rate here. Average P&Ls, you're seeing a lot of negatives, and US dollar, Japanese yen, the only one that posts a positive average P&L. Days held hovering around 2 to 3 days. And what's always interesting for me in determining kind of trade entry and trade exit, the time horizon. Here we've got the time stop hit, which I think is interesting. That kind of validates what assumptions that I ran are actually working here. And you're seeing that for something like US dollar, Canadian dollar, you're getting stopped out just by time a lot of the time. And
Makes sense.
So less of an effective measure because of all the trade criteria that we've used to simulate this. That's probably the least strategic, the most variable.
Yeah, I mean, and that makes sense quickly on the time thing. I mean, you have the the same profit and loss target across all these pairs, and CAD is probably the least volatile across the board, and so you're going to get fewer profit target hits and fewer loss target hits for sure, just because moving 1% in a week of trading is a large ask for that dollar CAD, whereas it's not that large of an ask for Aussie or for that pound has been pretty volatile, and obviously Kiwi probably the most volatile on this board. I'm surprised that the win rate is so low for this strategy that's essentially saying I will risk 2 for every 1. I would expect that giving more leash to my losses should expand my win rate here. And on the momentum side, we're not seeing it. I'm interested to see if we're going to see it on the contrarian side.
Yeah, let's flip over to the next slide and we'll cover contrarian strategies with the same criteria. There you're seeing boosted win rates from the momentum, but not necessarily anything screaming off the board here from a win rate perspective. We are seeing pretty consistent, 68% of the time in those Australian dollar, New Zealand dollar pairs. We're seeing more positive average P&Ls. Same thing around days held, same thing around time stops, but we are seeing, those profit target hits a lot more frequently than the momentum.
Yeah, this is more what I was expecting, especially for those commodity currency markets, Kiwi, Aussie, CAD. You've shown already that in the last few years, those markets have been very mean reverting. And so obviously a better setup for contrarians. Of course, past performance is not going to be indicative of what happens in the future. But it is one of the only things that we really have to go off of a lot of times is what is this thing tended to act like historically. And those currencies have tended to be more mean reverting. And again, a contrarian play in yen has not been a very good one unless you really widen out the scope and you're saying like, okay, I'm willing to sell 150s and hold through, 155 or 160 potentially for a reversion back down to 140. Because you haven't gotten mean reversion in that yen on a short-term basis like you're looking at here. That win rate below 60%, again, for a strategy where I'm risking 2 to make 1 is not a good setup. But nice to see that these commodity currencies continue to show mean reverting aspects, the different ways that you look at them. Getting an average P&L that's close to 0.1%. Keep in mind that this is, hundreds of occurrences, and each occurrence that is a profit, you're only getting 50 basis points, and every loss is 100 basis points. And so for that average to be, 0.5 of a percentage point, 5 basis points, 7 basis points, close to 10 basis points in one direction or the other, that kind of tells you like, okay, that's pretty solid. That's like if you're selling, strangles and S&P ETF, and the average credit that you're getting is like $3, and the average P&L was, 10, 20, 25 bucks. Pretty similar type of return here. And so that's just to say that it is meaningful when you're looking at low volatility,
right, but
high leverage markets like FX.
Yeah, like a 0.1% gain in some of these pairs could correspond to, 20 pips or so. And at a dollar per pip in some of these, you're looking at around 10% in some pairs for a potential profit. What about the win rate with this criteria, risking 2 to earn 1? Is 68% enough for you, or in theoretically with your more options focused background, what would you be looking for from that perspective? And if everything was defined risk?
Yeah, I mean, first of all, it's got to be more than 50%, right? Because if I'm if I'm losing just as often as I'm gaining, and I'm losing 2 times for every one,
Auga.
Yeah, not good. And so, I mean, I think the math does come out to be like you should be about 2/3 in the profit column
Right.
versus the loss column if you are risking 2 for every one. The thing that makes it murky, of course, is the potential like error term in your math is the right column here, right? Like it's the amount of times that you don't hit 50 basis point profit or 100 basis point loss. That's what kind of can decide again, like was your actual performance better or worse than the theoretical? Because of course I can write on a piece of paper and just be like, okay, like like 1 is the average profit times 68% win rate minus 2 the average loss times 32% the loss rate, but you're not hitting those maximums every time. And also that's, I mean, of course you can be as mechanical as like every trade I put on, I'm putting on my take profit and stop loss at exactly these amounts. And I'm just going to be super mechanical, and I'm going to throw the time element out of the window.
Yep.
But we are active human traders, and sometimes stuff will change. Or I put this trade on 3 days ago, and there's a Fed event in 2 hours, and like I have a small profit or a small loss. I'm just going to take that. So that makes it a little bit murkier. But I do, if I'm looking at any type of strategy, and I am risking more than I'm potentially going to take, I want to see success rates probably definitely north of 60%. In that 65 to 70% is where you start seeing like, okay, I can take this high probability strategy with a larger average loss.
Yep. Agreed. So we can go over to the key takeaways here. I think we covered most of them, but just to summarize that right now, the current trending markets that we called out, those in particular favor mean reversion strategies. The small profit targets that we used with the risk reward has performed relatively well, especially in this low volatility environment, much more likely than looking for those moonshots like we see in something like a dollar yen. Dollar yen favoring momentum, and that even with these pretty tight constraints, most trades can take more than 1 day across volatility environments.
The pound piece is interesting to me. That one actually did play pretty contrarian historically.